Okay, welcome. You're here because you want to get smarter, faster about the things that really count,
Right.
right? You want the actual insights, not just all the noise that's out there.
Exactly. Cut through the clutter.
So today, we're diving deep into a book that Warren Buffett himself called, well, by far the best book on investing ever written.
That's the one. Benjamin Graham's The Intelligent Investor.
And look, this isn't about finding the next hot stock tip or anything like that.
No, not at all. This is about the bedrock, the fundamental principles for investing wisely, whoever you are.
We've really dug into this one, specifically the fourth revised edition.
Yeah, which is great because you get Graham's original wisdom, which dates back to, what, 1949?
Right.
But then you also get these added layers, commentary from Jason Zweig, plus a preface and appendix by Buffett. It's quite the package.
It really is. And it kicks off with this quote from Virgil, from the Aeneid. Something like, "Through chances various, through all vicissitudes, we make our way."
Yeah. That really sets the tone, doesn't it?
It does. It speaks directly to how unpredictable the market is.
And Graham's whole point is to give you a kind of map, a framework to navigate all those ups and downs.
So our mission here in this deep dive is basically to pull out those core, timeless ideas, give you a shortcut to understanding this stuff that's still so relevant.
Absolutely. And right at the heart of Graham's whole system is this really crucial distinction.
Okay.
The difference between investment and speculation. This is absolutely foundational, but it's a line that gets, well, pretty blurry for a lot of people.
Okay, yeah, let's definitely unpack that. So in Graham's world, what is investment exactly, and how did he separate it from just, speculating?
Right. So for Graham, investing isn't casual, it's serious. It stands on three legs, basically.
Okay.
First, thorough analysis. You have to understand the business you're buying into. Second, and this is key, safety of principle. Protecting your initial money comes first.
Before chasing big returns.
Exactly. And third, after those two, you look for a satisfactory return. Not necessarily spectacular, but adequate. So analysis, safety, adequate return, that's investment.
And speculation.
Speculation is different. It's driven more by trying to guess market swings, hoping for quick profits, often without that deep analysis or the same focus on protecting the principal.
So less about the business value, more about the price action.
You got it. Investing is like methodical wealth building. Speculation is more like trying to outsmart the market's next move.
That sounds clear enough when you put it like that, but why do so many people mix them up? Graham talks about this, right?
Oh, yeah. He points out that back in, I think it was 1948, something like 90% of people they asked called themselves investors.
Wow, 90%.
Yeah. Even when their actions, like buying stocks on margin, which we can get into, were clearly speculative.
So why the confusion? Is it just self-deception?
Partly, maybe. But Graham suggests it's often about the excitement, the thrill of a potential quick win. Or maybe fear of missing out. FOMO isn't new.
Huh, right.
And these are exactly the emotions Graham warns against. He'd say recognizing that psychological pull, that temptation, is step one to being an intelligent investor.
So what is it about speculation that's so tempting?
Well, it's the lure of hitting it big, fast.
Right.
The possibility, however slim, of huge returns really quickly.
Like gambling.
Graham basically compares it to that, yeah. Or betting on horses. The odds might be against you, but the potential payoff feels huge.
But he advises against it for most people.
Strongly. Especially for the non-professional. He figured most folks just don't have the time or the specialized knowledge, or maybe even the right temperament, honestly, to win at that game consistently.
You mentioned buying on margin earlier as a clear sign of speculation. Can you break that down a bit? Why is it so speculative?
Sure. Margin buying is essentially borrowing money from your broker to buy more stock than you could with just your own cash.
Okay, using leverage.
Exactly. And leverage cuts both ways dramatically. If the stock goes up, your profit percentage is magnified because you controlled more shares.
Sounds good so far.
But if the stock price drops, your losses are also magnified. And you still owe the broker that money you borrowed, plus interest, no matter what the stock did. You could lose more than you initially put in.
Oh, okay.
So for Graham, that kind of leveraged bet, it just doesn't have the safety or the deep analysis of real investment. It's purely a gamble on which way the price will move short term.
Got it. Now, Graham wrote and revised this book over a long time. The edition we're looking at, the fourth, was from the early 1970s. What was going on in the markets then? How did that influence his thinking?
Yeah, the early 70s were pretty choppy, lots of economic uncertainty. Both stocks and bonds were bouncing around quite a bit.
So volatility.
Right. And Graham uses this to emphasize that, hey, this unpredictability is just part of the deal. Investors need to expect it and plan for it.
Makes sense.
But what's really interesting is that around that time in the early 70s, he actually started arguing that common stocks looked potentially more attractive than bonds for the long haul.
Oh, really? Why was that? Usually bonds are seen as safer.
Well, the big worry then was inflation. Rising inflation eats away at the real value of fixed payments you get from bonds.
Ah, okay. Your dollars buy less later.
Exactly. Graham argued that companies, through potentially higher earnings and dividends, might keep pace with or even beat inflation, giving stock investors a better real return over time compared to bonds in that environment.
That's a pretty big shift in perspective, isn't it? But does that mean he suddenly became a cheerleader for loading up on stocks?
No, not at all. That's the crucial point. He saw the changing landscape, the inflation threat, yes, but his core principles didn't budge.
Still cautious.
Very much so. He still strongly advocated for a balanced, prudent approach, especially for the type of investor he called the defensive investor.
Okay.
And importantly, even while saying stocks looked relatively better then, he was still super skeptical about anyone claiming they could accurately predict the market long term. He knew forecasting was, well, mostly futile.
Right. Okay, so this defensive investor, let's dig into that. Who is this person in Graham's view? What are they trying to achieve?
The defensive investor is basically someone whose main goals are, number one, keeping their money safe, preservation of capital, and number two, avoiding a lot of worry and effort.
So peace of mind is important.
Very. They aren't necessarily aiming to shoot the lights out with incredible returns, but, and this is important, defensive doesn't mean settling for bad returns either.
Okay. It's about minimizing risk and stress, primarily.
Exactly. Prudence over excitement.
So what does that look like in practice? What kind of portfolio did Graham suggest for this defensive type?
His basic guideline was pretty simple. Keep roughly equal amounts in high-grade bonds and high-grade common stocks, like a 50-50 split.
50-50. Okay. Was that set in stone?
No, he allowed for some flexibility. He said you could let it drift, maybe between 25% and 75% in either stocks or bonds, depending on market conditions.
So some adjustment is okay.
Yeah, but he warned against going to extremes. Don't go all in on stocks or all in on bonds. That balance helps manage risk and capture different opportunities.
All right, let's break down the two halves. The bond part. What did he mean by high-grade bonds? What qualified?
High grade meant safe. Low risk of the issuer defaulting. Think things like U.S. savings bonds, super safe.
Government-backed.
Right. Also, high quality corporate bonds from stable companies and state and municipal bonds. He noted the tax advantages of munis at the time, too. Generally, bonds with top credit ratings.
Did he mention things like convertible bonds or preferred stocks?
He mentions them briefly, yeah, but generally saw them as maybe more suitable for the other type of investor he talks about, the enterprising one. We might get into that later, but for the defensive investor, it was mostly about plain vanilla, high-quality debt.
Okay. And the other half, the high-grade common stock component. What was the approach there for the defensive investor?
For stocks, the key ideas were diversification and quality. Spread your money across a good number of companies.
Don't put all your eggs in one basket.
Pretty much. And focus on well-established, financially strong companies, ones with a long history of making profits, solid balance sheets, and ideally, a record of paying dividends consistently.
And how should the defensive investor actually buy these stocks? Lump sum.
He actually recommended a strategy called dollar cost averaging.
Ah, okay. Heard of that.
Yeah, it's perfect for the defensive type. You invest a fixed amount of money at regular intervals, say every month or quarter, regardless of what the market's doing.
So you buy more shares when prices are low, fewer when they're high.
Exactly. It averages out your purchase price over time and, crucially, takes the stress out of trying to guess the market's peaks and valleys. It enforces discipline.
That fits the low worry goal perfectly.
Mm-hmm.
Now, were there specific things Graham said this defensive investor should absolutely avoid?
Oh, yeah. Big warnings. First, stay away from new issues, what we call IPOs today.
Initial public offerings. Why avoid those?
Too speculative for the defensive investor, in his view. Often not much history to analyze, lots of hype, very volatile prices usually. Just not worth the risk for someone focused on safety.
Makes sense. Anything else?
He also warned against second-grade or lower-grade bonds, junk bonds, essentially.
Higher yield, but higher risk.
Much higher risk of default. Again, doesn't fit the defensive profile. safety first.
What about people who just feel overwhelmed by picking individual stocks and bonds? Maybe they don't have the time or, the expertise.
Yeah, Graham addressed that. He
Wow.
basically said, look, if that's you, then investing in well-established, reputable investment funds, mutual funds, essentially is a perfectly reasonable, sensible option for the defensive investor.
So outsourcing the selection, but keeping the principles.
Right. You get diversification and professional management without needing to become an expert stock picker yourself.
Okay. Now, we all know markets go up and down. It's just what they do.
Hmm.
How did Graham say the intelligent investor, especially this defensive one, should think about those swings? How should they react?
This is one of his most powerful insights, I think. Graham basically flipped the script on market volatility.
How so?
Instead of seeing downturns and fluctuations as scary or bad, he saw them as potential opportunities.
Opportunity.
Yeah. He even included this table in the book, Table 3.1, showing all the major market swings going way back to 1871, just to drive home the point that ups and downs are normal. They happen.
So opportunity.
Yeah.
You mean like a chance to buy things cheaper?
Exactly. When the market tanks and fundamentally sound companies get dragged down with it, their prices might become really attractive undervalued.
Right.
That's a buying opportunity for the patient, rational investor.
Buy low.
And conversely, when the market gets wildly euphoric and prices seem way too high, detached from reality, that might be a sensible time to think about selling.
Sell high.
Oh.
Okay. But isn't that kind of like market timing, which he warned against?
Ah, good point. He drew a careful line there. It's not about trying to predict the next move or constantly trading in and out. That's speculation.
No.
It's about recognizing when prices, due to broad market swings, get significantly out of whack with underlying value and acting opportunistically within your long-term value-focused framework. Be ready to act when the market gives you a clear pitch, but don't swing at everything.
That sounds logical, but it must take some serious emotional control, right?
Yeah.
Not getting swept up in the panic or the greed.
Absolutely critical. Graham hammers this point home. Emotional discipline is paramount.
Don't let fear or euphoria drive your decisions.
Precisely. You can't let the mood of the market dictate what you do. You need to stay rational, stick to your analysis, focus on the value, not the noise or the crowd's sentiment. Easier said than done, of course.
For sure. And this connects to another huge Graham concept, right? The margin of safety.
Yes, the margin of safety. It's maybe the cornerstone of his whole philosophy.
Okay, what does that mean practically?
In simple terms, it means only buying a security when its price is significantly below your best estimate of its real intrinsic value.
So deliberately buying things for less than you think they're worth.
Exactly. That difference, that gap between the price you pay and the estimated value, that's your margin of safety. It's a buffer.
A buffer against what?
Against being wrong, against errors in your analysis, against unexpected bad news for the company, against just general market downturns. It gives you room for error.
So it's fundamentally about reducing risk.
Absolutely. Especially for the defensive investor whose main goal is preserving capital. Prioritizing a good margin of safety in every purchase is how you protect yourself from significant losses. It's like buying a house for way less than its appraisal. You've got a cushion if the market softens.
That makes a lot of sense. It's a built-in safety net.
Right. He gets into it deeper in later chapters. Chapter 20 is key, but the principle underlies everything, especially for the defensive approach.
Okay, so if we're wrapping up this first look at the early parts of The Intelligent Investor, what are the absolute must-remember points for someone listening? The key takeaways.
I'd say there are three main things, really. First, get that difference between investing and speculating crystal clear in your head. Investing is analysis, safety, adequate returns. Speculating is chasing price swings. Know which game you're playing.
Okay, distinction first.
Second, understand the defensive investor profile. If safety and low stress are your priorities, then embrace that strategy. Balance high-quality stocks and bonds, diversify, use dollar cost averaging.
Got it. Defensive strategy.
And third, change your mindset about market swings. Don't fear them. See them as potential opportunities if you stay rational and disciplined. And always, always insist on that margin of safety.
Invest versus speculate. Defensive approach. Rational mindset with margin of safety.
That's a pretty good summary, yeah. Those are the pillars from these early chapters.
It really is striking how relevant this all still feels, isn't it? Ideas from decades ago, but they provide such a solid foundation for navigating today's markets too.
Totally. The specifics might change: interest rates, technology, whatever, but the principles of human behavior and sound investing, they seem pretty timeless.
So maybe for everyone listening, the question now is, How do these ideas fit with your own goals, your own tolerance for risk? Something to think about.
Definitely. And maybe the final thought is this. Real long-term investment success probably doesn't come from finding the next big thing or timing the market perfectly.
Yeah.
It more likely comes from cultivating that discipline, that rationality, that long-term perspective Graham talks about. His wisdom really endures.
A powerful reminder. And as you said, we've really only scratched the surface here.
Oh, absolutely. If this resonates, digging deeper into the intelligent investor itself is definitely time well spent. There's so much more there.